Very warm welcome to everyone. So in this brief update, I thought I would cover the following things. First, a brief recap of what the fund is and how we work. What have been the most important drivers of performance year to date before we delve into the portfolio as it stands at the end of September and how we're positioned for the outlook as we see it today. But just going back, I mean, SKAGEN Kon Tiki is a global emerging markets fund. It started back in 2002, so a very long track record. The current team, which is myself, Katrine Geta, and Espen Klette, has now been together for almost 6 years since Espen joined Katrine and myself back in 2019. Now this is an experienced team in our view. We all have sort of other experiences, but always had a focus on fundamental and long-term investing. And I think that's important in terms of the investment horizon and the way that we position the fund. So we follow the same investment philosophy since inception. We are bottom-up stock pickers, and we make full use of the unconstrained global mandate that we have. We have an absolute return mindset. We don't invest relative to an index, but we go where we see value on a stock-by-stock basis. Our long-term investment horizon we define as minimum 3 to 5 years, but we have holdings in the portfolio that have been there for a decade or more. The longer your time horizon, the more important we think that integrating ESG and sustainability into the investment process becomes. And we think that this is one of the more important sources of mispricing and misunderstanding that can occur, particularly in emerging markets. We think that having a contrarian mindset is therefore a plus. We are able to look perhaps where the market is fearful for other reasons. And as we will go through in a couple of examples, it does sometimes pay off to deviate from the crowd. We also think that it's important that the portfolio reflects the strategy that we follow. And as you can see here, the key tenets of the investment strategy is, we are active investors. That means we're very different from the index. You can see it on the left-hand chart, almost 90% active share in the fund, which has been reasonably stable over time, despite having a portfolio that also includes some of the more well-known names that you may recognize from elsewhere. When we say that we are different, you can see on the right-hand chart in the blue bars is the fund's positioning in terms of market cap spectrum. You will see that against the index in dark blue, but more importantly against our peers, so other active EM funds, we have a much higher weighting towards small and mid-cap names. And this is really where we think that the likelihood of finding these very mispriced securities, perhaps more overlooked by the market, and the return on our time and our independent analysis is likely to yield higher rewards. And finally, by being value-based, you should expect the portfolio to trade at a discount over time. And as you can see, the portfolio still retains a sort of 40 to 45% discount, both on price to earnings and on price to book multiples. And as I'll go on to show, that's without making any meaningful sacrifices in terms of the quality of the portfolio. So if we put it into context, effectively what we're trying to do is to get much more in terms of the value creation from the portfolio companies that we own relative to the price that we've paid. And a 50% discount or so, we don't think is the worst place to start looking. This is also corroborated by third-party data. Here we have the portfolio in the blue dots compared with the average fund in the active universe in the black lines. And it shows that on the key sort of valuations, so style and quality metrics, that our discount in terms of valuation is much, much more material relative to our peers than the quality differential. And if we move that on to sort of the discount that the portfolio trades on, it doesn't matter if you look at current year earnings or sales or asset bases, on any kind of metric you look at, the portfolio is trading at a sort of 30 to 50% discount. So the value characteristics are very, very much in place, despite having delivered strong absolute returns recently. If we go into the returns, firstly, the long-term record since inception has been for the retail share class about 10% per annum in euro terms since inception. That's about 3 percentage points higher than the benchmark return in the same period. However, it is worth highlighting that that return period can be broken down into two. The first 10 years when emerging markets were delivering very, very strong absolute returns, when the fund was delivering close to 20% annualized return. And then more recently, over the last 10 years, when emerging markets equities have been increasingly out of favor and delivered, I think, frankly, disappointing returns if you look in the back mirror, and that has also affected the fund. But as you can see, as we go further towards the left, there has been an improvement as of late in terms of the absolute return delivered from emerging markets, with the fund up 14% in the retail share class as of the end of September. I've also on this chart included our gross performance figures, so those are before fees, because we do offer multiple share classes for larger investments. So clearly, if that's something that you think is relevant to you, you should reach out to our sales team to find the appropriate share class for you. Then if we go into what's driven the portfolio so far this year, if we start from an asset class perspective, it's been another good year for investors overall, as most major asset classes delivered good returns here shown in US dollars. It's paid off to take risk, as equities have done well, and it's actually only beaten by gold so far this year. And it is probably an anomaly that gold has done so well despite risk assets also having done well. And I think that reflects some nervousness around US fiscal and monetary policy, but also continued strong demand from both from emerging markets like China and India. On the negative side of the chart, you can see that oil has been weak despite the tension in the Middle East, while fixed income has delivered more or less in line with the expected yields from the different types of risk spectrum. If we then think about the portfolio, we entered 2024 with a portfolio that was broadly positioned in 3 key markets within emerging markets, and they made up at the time over 60% of the portfolio. These were China, South Korea, and Brazil. And what they all had in common, other than being lowly valued both in absolute terms but also relative to their history, was that we thought we saw clear triggers for what would deliver a re-rating. So if we start with China, there we were waiting for the authorities to step in to stabilize the economy and for the stock market, which has been in a downtrend since 2020, to benefit. We also had clear expectation for reforms to the government's Value Up program in Korea, something that we've discussed in previous webinars, and that improved corporate governance and a greater focus on minority and shareholder returns would help that market. Finally, the very high policy rates in Brazil as we enter 2024, we felt had a room to fall as inflation was coming down, and we believe that this would disproportionately benefit equities, which at the start of the year looked attractively valued to us. So to start with the first, the Chinese authorities did in the end take action this year. The economy, to start with, that has been weaker than expected, and it now looks like they may miss the 5% GDP growth rate target for 2024. And in my recent trip to Hong Kong last month, it was pretty clear from the mood on the ground that both corporate results, but also the mood amongst consumers in particularly, was pretty downbeat. What we've seen since then is a coordinated policy response, both monetary and fiscal support having been announced. And you can see that clearly in the last 2 weeks, where the market reaction has been immediate and very, very forceful since the end of September. And so much so that Chinese equities are now up some 30% in euro terms as at the end of last week. Now, the details of any support from China is still yet to come, But I think that the fact that authorities have stepped in and given a clear signal is beyond doubt, and we will await the details and position accordingly as we go forward. Now, with a 30% plus rise year to date, China is actually now the best performing major stock market globally as at the end of last week. Unfortunately, when you look at the chart, the other two main markets that we've been exposed to this year, Korea and Brazil, have fared less well and are the only two major markets that have posted negative returns year to date. As always, there are many reasons for this. I think in Brazil, we did see initially the policy rates came down, but they have recently increased again, and there is a growing concern about the fiscal situation and the budgetary restraints under President Lula's government. In Korea, the index return has been held back by weakness in Samsung, which is a very large constituent. But actually, when we look under the hood and look at some of the value up initiatives and our holdings in Korea, they have done quite well and as expected under these successful reforms to date. But I also think it's worth reflecting on some of this year's performance relative to last year. And here I actually ranked the same markets on their performance last year. And what you see is actually when you take Brazil and China, they were effectively the best and the worst markets last year. And so far this year, that has been reversed. The best markets during the whole sort of near 2-year period have been those that have delivered consistent returns both years, and that predominantly for our case being India and Taiwan, where we've had less exposure than we would have liked given the performance. When you look at the portfolio, it's therefore no surprise that the effects of market returns have also played out in our larger holdings. So our largest Chinese investments, CNOOC, the upstream E&P company, insurance company Ping An, and the internet giant Alibaba have all been very, very strong performance, slightly ahead of the local market, but still driven by Chinese market rally. And on the flip side, our larger Brazilian holdings have also suffered in line with or slightly worse than the market as the market has struggled there. But I think also I just want to highlight one other company here on the chart, which is Hyundai Motor. It's a very long-term holding in the fund, I think coming up to 15 years. And it is very pleasing to see that, yes, they've continued to deliver operationally this year, but what we've also seen is a very clear framework for shareholder returns having been put in place. And we're very happy with the progress that we've seen at Hyundai and other Korean companies that we've been engaged with over the last few years to see that this focus on minority shareholders is starting to yield tangible results. I also just, because we've received so many questions on our China exposure over the last 3 and a bit years, I just want to give a little bit more context to what's been going on there. As many of you will know, the market's been in a downtrend since the end of 2020. And as we've communicated previously, we have consistently been increasing our exposure to China since the autumn of 2021. However, if you see on the left-hand side, that's a chart which basically shows the net return of the portfolio in those 3 years, 2020 to 23, and then within that, our investments in China. So despite the market having fallen by nearly 50% in that period in euro terms, the China investments within the Kon Tiki portfolio actually delivered flat results in that period as we were increasing exposure. What's interesting and pleasing to see then, of course, is that as the Chinese market has rallied this year, we have been correctly positioned for that rebound. We've had a large enough exposure, and again, the stock picking within our China exposure has paid off. And so far this year, our Chinese investments have delivered nearly double the return of the China index as at the end of September. Obviously, with those kind of moves that we've seen, and I'm sure we'll get questions again, it is all else being equal when you get such a big rally in share prices. With our contrarian and value-driven investment approach, you should, of course, expect us to make some adjustments given the veracity of the rally. If we go into the portfolio and what it looks like at the end of September, the first thing just to note is that we continue to have good activity levels in the portfolio. We've had 8 new companies join the portfolio so far this year, and the turnover ratio in the portfolio is roughly 30%, which is bang in line with the 3 to 5 year investment horizon that we practice. Now, what we're pleased with in the team is that we have been able to bring in companies either that we have owned in the past. So the Chinese baijiu or white liquor producer Wuliangye was a successful investment for us back in 2008, 18-19, and we were able to bring that in prior to the policy driven rally that came in September, October. So we've been able to sort of re-enter that at very attractive levels. Also, what we've done, and we talked about this in the past, is that we do own a number of conglomerates or groupings of companies. And what we've also done this year is to bring in 2 holdings, both the shipping company CSAV from Chile, but also for a shorter period of time, Grupo Vamos, a truck leasing company from Brazil. Those have both come about as we were shareholders in their parent companies already. So having this sort of sphere of companies with which we have comfort in management, in which we can source new ideas from, is an important part of the way that we work. We've also exited 7 investments so far this year. In China, we exited both the telecom equipment producer Foxconn and the white goods manufacturer Gree, as they've reached our target prices. So it's always good to be able to lock in sort of the gains that we expected at the time of making the investment. But we've also had to make more difficult decisions where we have sold out of both Korean furniture manufacturer Zenus and also the land-based salmon farming company Atlantic Sapphire on disappointing or continued disappointing operating performance, and therefore a lack of conviction in the case for the long term. So we do also take action when we feel that is necessary in order to redeploy capital into the more attractive opportunities as they come along. To go into the top 12 holdings of the portfolio, which accounts for roughly 50% of assets, there are actually no new investments that have floated into the top 12. So you will recognize many of the names, such as Alibaba, CNOOC, Samsung Electronics, Hyundai, etc. But we have made some gradual changes within the ranking of those. So we have made increases during the summer to both Ping An Insurance, but also Taiwan Semiconductor when they were at attractive levels, and that's paid off well. Similarly, we have been increasing our exposure to Yara International, which is a global fertilizer company where we think that the cyclical downturn makes it for an attractive turnaround case. What it's also meant is that we have reduced some of our longer term holdings. So both Samsung Electronics, which has been a weak performer this year, we had actually reduced at the start of this year, so that the drawdown in that was somewhat contained, whereas Hyundai Motor, given the very strong rally that we've had, has also meant that we have reduced some of our weighting there to keep it at a reasonable level. You also see that CNOOC, which has been one of our top holdings for the last 3 years, always in the top 3 during that period, has also been reduced quite significantly as the remaining upside to our scenario weighted target price has come down, and also with the oil price sensitivity that is in that stock, we also feel that that is a prudent portfolio adjustment. When you look at the valuation of the portfolio, you can see that although not every single stock is cheap on near-term multiples, the aggregate measure of the portfolio is still at that very significant discount to the market. And despite sort of the many of these stocks having done well over the last 12 months in absolute terms, we still continue to see very attractive or around 40% upside to our independent target prices, which are based on 2-year forward looking. And then finally, just on the portfolio, I just want to again stress the sort of how do we think about the value for money angle. So here is third-party data from Copley Fund Research, They have a database of just over 350 active emerging markets funds. Here they're all ranked from left to right on price to earnings multiples and earnings growth expected for the next 12 months. As you can see, Kon Tiki scores very well on low valuation, but still has a high expected growth in the near term in the portfolio. Similarly, if you look at on the price to book basis, the price to book basis is very low compared to comparable funds, but this is not because the companies that we own are unprofitable or are not paying attractive dividends. Again, low valuation with a corresponding high expected return, either in the form of dividend yield or in growth embedded in market expectations. So that is what we are trying to solve for on a continuous basis. So to give you a little bit of an example of the types of companies or types of situations we find ourselves in, also when we are traveling to meet companies or learn more about new markets. Last summer, I traveled to Mexico. I'm sure many of you will remember that Mexico during 2023 was a very, very seemingly attractive market, reshoring of manufacturing capacity from Asia to come closer to the US market meant that there really was a boom in industrial activity in Mexico. We thought that, you know, a good way to look at that would be industrial real estate, which we had discussed with our colleagues in M2, the real estate fund, and we went out there. Now, as it turns out, you know, I have a picture there. This was the only bear that we encountered in Mexico. The mood at the time was incredibly upbeat, and the only sort of bearish statue I found was outside one of the intercity parks. But what we do when we travel to these places is we always try and also look for what could possibly be out of favor. And one of the stocks that came up from our screens before going was a Mexican company called Genoma Lab. As you can see from the chart, it's roughly 50% in Mexico, 10% in the US, and 40% in Latin America. Now, this is a company that is basically 50-50 and over-the-counter medicine. Think cough syrups, gastro treatment, the baby formula, those kind of things, and 50% personal care and isotonic drinks. So this should really be a pretty stable company, but what we found was that this was one of the worst performing stocks in Mexico prior to us arriving there. It was down by roughly a third in absolute terms in what had been a continuously rising market, and obviously that piqued our interest. Now, what we found is that the company had at the time a roughly 25% of earnings exposure to Argentina, and as I'm sure you will recall from 2023, that was prior to a closely fought election in Argentina and also fears over inflation and devaluation risk. So what did we find when we met with the company? We found a company that had a clear plan to increase margins. And what they were doing at the time was to move production in-house, which would allow the company, A, to cut costs, but also improve the operational flexibility of the company and therefore improve its margins. Now, they had a 1.8 billion peso program, so roughly 90 million euros. And when we met them, we were already starting to see progress on this margin expansion. As you can see, it had sort of 2 quarters of improving margins by the time that we met them. But of course, at the time, this was completely overshadowed by fears around Argentina, which led to a big de-rating of the business as fears of the sustainability of the earnings stream was coming through. So what's happened since then is that the company has continued to deliver improving margins on a consistent basis, but management have also given very, very clear targets for the next 2 years. And as you can see, they are well on track to meet the sort of margin targets that they gave for the current year, and then they expect further improvement next year as these cost savings and operational improvements come through. So what are the kind of operational improvements that we are looking for? Number one, these are simple things. When you move production in-house, you take more control of processes. So number one, they've reduced the weight in some of their plastic bottles. They've redesigned the caps on their isotonic drinks. And this alone, they think, is 100 million peso savings, so roughly 5 million euros, or more than 5% of the targeted savings. Another example is re-engineering and standardizing shampoo packaging, and therefore also be able to better source raw materials. And finally, one of my favorites is just having the same kind of cardboard packaging for similar products in different markets, and basically reducing the number of suppliers from 23 to 2 and reducing the number of different options. Again, a modest but important and gradual saving that comes together. So what we liked here is that you had a company where the stock price was under pressure for something to do with the market, which was outside of their control. And then you had a very, very clear company-specific story on things that were very clearly within management control. And this we like as a setup. So what's happened? So firstly, I think, yes, the worst case scenario, or for many people, what they were worried about in Argentina did play out. So you did get a new president, which with some people is popular and with others he's not. And you did get the devaluation of Argentinian pesos. So what it turned out was that the market was paying a low multiple for an earnings stream that was coming down. However, what's happened on the ground in Argentina is that Genomma Lab have continued with above inflation pricing taken in the market. They've been able to protect their margins as a result of that. And they've also been able to invest countercyclically within Argentina. The profits that they've generated there, they've been able to invest in acquiring new brands and acquiring production capacity and real estate. So what you see is that as that sort of is starting to play out, the momentum in the Argentinian business has improved, and as a share of sales, it is now growing again. So all else being equal, the Argentinian business in the last quarter was significantly outperforming the rest of the business. And when you put those two things together, what the market was worried about getting better, and the company delivering on the company-specific levers it itself had to make improvements, you get a pretty powerful reaction. So again, we traveled to Mexico because the macro story looked attractive, but what you see in the green line is that the Mexican market has actually been quite disappointing since we returned from Mexico. What you can argue is that most of the good news was already in the price. On the flip side, when you see the light blue line, which is the Argentinian market in dollars, the devaluation that happened is very clear and obviously very, very painful in the short term. But again, the negativity that was already priced into the market for a long-term investor yielded a risk reward, which with the benefit of hindsight looked to have been more attractive. Now, the interesting thing is, obviously, with Genomma Lab, you now have a company that has emerged from what the market thought was a crisis, clearly strengthened, and now with also very, very strong momentum in the part of the business that the market was worried about. So you never know when you go on some of these trips where you're going to find the best opportunities, but I think this is a good example of being able to look slightly differently at a situation, at a market, and finding a mispriced opportunity. And because of the limited market cap, this was a sub $1 billion market cap company with limited coverage from the sell side community, which again opened up the opportunity for us to do independent work. So as we look forward, how is the portfolio positioned now? Well, I think the first thing to just note is that this is a chart we've put together which basically shows the index upside to the 5-year high. So basically the highest point that these markets have been in the last 5 years, how high would it have to rise from the current level? And unsurprisingly, given how strong equities have been this year, there is limited upside to recent highs. So you need to believe that the market will continue to power ahead. There are some outliers, however, and very many of them are to be found in emerging markets. So again, China, because of the significant drawdown it's had over the last 3.5 years, does still offer upside to its 5-year high. And also in terms of Korea and increasingly Turkey, which we are spending time on, are markets where purely based on index levels could be interesting hunting grounds. Now, if you combine that with valuation, it's another picture emerges. So if you look on the left-hand side of the chart, The blue dots is the current PE multiple on 12-month forward earnings. It's ranked from high to low. So not only are the markets that are highly valued, they're also highly valued versus their history. So the 10-year median multiple is in the triangle, and then the 95th to 5th percentile is in the shaded box. So markets like India and the US have only traded at these levels or higher 5% of the time in the last 10 years. If you go on the other side of the chart, you see markets that not only are cheap relative to other places, but they are cheap relative to their own history. So I appreciate that comparing a Brazil versus an India and a macro story makes you sort of want to say, well, I much prefer a top-down story, one country over the other. But that's why we also introduced the concept of looking against their own history. So yes, Brazil has a more challenging macro outlook than India does. Of course it does, but is it more challenging than it has been over the last 10 years is what we think is a more relevant question to us. So again, you should expect us to focus on these kind of areas where there are clear outliers in terms of potentially attractive valuation. So on an aggregate basis, just final slide here before we sum up, we do get questions now and again, you know, why bother with emerging markets? They have done very poorly relative to developed markets over the last 10 years. It's very difficult to sort of pinpoint what will make that change. But here what we've done is just take a chart from Bank of America, which basically shows the price index of emerging markets relative to the US market, which of course has been the big driver of global equity returns. And we are now at levels not seen since 1969. There are of course many good reasons why that has been the case, but it does paint an interesting picture that the sort of the long-term cyclical nature of relative returns in markets, and when you combine that with valuations, we think that still the setup for emerging markets with low valuations, low expectations is still an interesting place to look for differentiated returns. So again, just to reiterate, you know, SKAGEN Kon Tiki continues with its value-based long-term investment philosophy that's been stable since the launch in 2002. The portfolio, which at the moment consists of just over 40 names, is quite concentrated in the number of holdings, but it does offer balance across both geographies, sectors, and also themes. The only thing that each individual stock in the portfolio has in common is that based on our independent analysis, which is often different from the market, these stocks are undervalued in our opinion, and quite often those will also overlap with unpopular areas of the market, where I think Enoma Lab is a good example of how that can pay off quite well if you get the fundamental analysis right and can articulate where the market may be looking in the wrong position. And as ever, we think that, you know, with the number of markets and the risk that we are exposed to throughout emerging markets, I think, you know, each market has its own attractions and risks. We do believe that active and value-based investment philosophy is a good way to navigate those different markets. So with that, I will hand back to Ole Christian and see if there are any closing questions.
Thank you indeed, Fredrik. Now, if you have any questions, do please use the Q&A button at the top of your screen. In the meantime, I have a question for you. The recent run-up in the Chinese market seems to have caught many investors off guard. How has Kon Tiki navigated the more recent volatility?
Well, I think as I mentioned earlier, you know, one of the reasons why we were happy with our positioning in China was because of how non-consensus it was starting to become. So when we added to, for example, our holding in Ping An back in July, it was on the basis of seeing that other investors were increasingly negatively positioned. What we've seen then with the returns that have come through is that, it was a very, very rapid closing of some of the gaps versus our expected valuation. So it wouldn't surprise many of you if we said that we have been reducing some of our investments in China on the back of these much, much higher prices than where we bought them. But I think, again, just to stress, in a diversified portfolio, we're still finding lots of interesting opportunities within the Chinese market. There are misunderstood companies, low valuations, and still in certain areas, low expectations.